Every 2 weeks on Wednesday, we are diving deep into the world of options trading, exploring the fundamentals of puts and calls and how you can effectively incorporate them as an investing tool to maximize your returns and manage risks. So you can call us toll free if you have a question, 1-855-326-6266, or email us at knowyouroptions@bnnbloomberg.ca, and we will answer your questions. So let's bring in Chris Tom, CEO and Portfolio Manager at Moat Financial. Great to have you in studio.
Yeah, good to be here. Thanks.
It's been interesting lately, I think, to say the very least. There's been a lot of volatility in the markets, and maybe a lot of investors have been riding a bit of a high for a while, but want to start to kind of get away from any risk, right? So what would you advise investors to do to kind of hedge themselves against the risks that are out there right now, given the roller coaster we're on with the markets?
Yeah, I mean, the volatility in the market, people only ever seem to talk about it or feel it when it's downside volatility, right? If we see, gyrations in the market, but on net, it's moving higher, people tend to get a bit complacent. And now when, things are going a bit wild, that's when people start to look at wanting to reduce risk and use options in order to do that.
So in terms of doing that and trying to avoid like the fear and panic, as you talk about the kind of the negative sides of it, how can they do that?
Yeah, so obviously the first thing you can do is if there's too much volatility and the equity market is not for you, then you can sell your stocks. You can move into fixed income. Obviously, with that, the trade-off, you get the security of fixed income, but you get a lower rate of return over the long run historically. The other thing you can do is if you want to keep that equity portfolio on, you want to keep those positions, you can buy protection using put options. So whether it's over an entire portfolio or on individual names, you can buy puts and that will set you up for a protected portfolio.
Is it that easy? I mean, for people who are watching, it's like, okay, sell your stocks, buy puts, there's no downside?
Yeah, so it is that easy in that you buy that put at that level and it goes up in value as the stock goes below that price. So where you'd be losing on the stock or the portfolio, you'd be making money on that put option. So yes, it is that easy, but the difference is you have to pay for that. Okay, so it's like any other insurance policy that you might have on your house or your car or whatever. You've got to pay for it. So that is where you need to actually pay attention to what am I paying for this and is it worth doing?
I guess that's the question, right? Is how do you know whether you're paying too much for something? Is it worth it? Like how can people assess that? I guess it depends on what you're looking at for sure.
Yeah, so I mean, just buying puts straight up, it can be expensive, right? Options,
yeah.
I come on here every 2 weeks, and the majority of what I talk about is selling options. So that's where we make our money selling options. We're selling that protection. These types of markets when volatility goes up, like we love it. It's great. Option prices go up, we get more for those options that we're selling. But if somebody wants to hedge themselves, they need to be able to buy that protection. And then there's a couple different strategies you can employ to reduce that cost. So I think we got the first board here, just a real simple board, just shows, okay, if you're long a stock and you buy a put option, in this one we use an example of paying $6, you have no cap on your upside. The stocks, if they go up, you participate in that, and then you're protected all the way down to zero. If that stock goes down, you won't lose money.
Interesting. That's one strategy.
That's one strategy.
Okay, what's the other?
So if we go to the next one, this is where if you think that a stock might go all the way to zero, probably isn't worth owning. You should probably move on to something else. So we typically like to use a put spread. Okay, so that's where you are protecting yourself in a window. So here you're going to buy that same put that we talked about in the first trade, but you're going to sell a lower strike put in order to help pay for that. So in this example, you buy the one for $6 and you sell a lower strike put for $3, and now you're protected in a window. So you've got full protection during that window, and then below that, now you're re-exposed to the market.
Is one better than the other? Like, if someone's listening and you've got these two strategies, which one should they pick?
So for me, when we're doing it, we always want to try to sell options in any one of these trades. If you're just buying options, it can be quite expensive, right? Say you're spending 1% a month to insure or protect a portfolio. Well, that's 12% a year. That's going to eat into your overall return. So if you can cut that in half, then all of a sudden you are really reducing that outlay and it's eating into your return less. And if the market, if you're going to hedge yourself the first 10% of that downside, you're going to trigger that protection a lot more than if you're just protecting all the way to zero. So if the market drops 20% and you're hedged for the first 10, that's good, right? Your relative position compared to a long-only investor is much better. And so here you're doing it for half the cost. So we want to try to sell options when we're doing any of these things.
So obviously, if a stock drops a lot after a lot of rallies, like this could be setting you up to be left with some regrets, which I guess is kind of investing to begin with, right? Like you're kind of putting that risk out there to begin with.
Yeah, I mean, if you've ridden the market higher and then the market shifts direction and you protect some of that downside, that first bit, then you're actually going to be in a much better relative position and you're outperforming the market. So there is a way to reduce that cost a little bit more and potentially even have a $0 outlay. So I think we've got one more board here, and so it's kind of building on each one. Mm-hmm. So first we were just going to be long that put. You're protected all the way to zero. Then we're going to reduce the cost by half by selling that lower strike put. Now we've got that put spread. And now because we own the stock, we can sell a covered call, right? Covered call is something the market's pretty comfortable with. It's covered call ETFs grow. Everyone seems to be really grasping what they are. So now if we sell that second option, and we can actually bring in the same amount of premium on the two options that we sold as the one that we bought. So we can actually spend no money in setting this up. Now, the drawback is now our upside can be capped. But we're protected. In this example, there's no numbers on the percentages, but effectively here you're protected for the first 10% of downside, and you participate in the first 10% of the upside. So it's a happy medium.
Okay, yeah, this is a happy medium. Just depends on how much risk you want to really put out there, right?
Yeah, with these options, there's always a cost. So sometimes that cost is money, and sometimes that cost is selling potential upside or participating in some downside. So it just depends on how you want to structure it and what's more important to you, potential upside or cash from your portfolio.
Okay, we are going to take a quick break here because I know we've got a lot of questions to answer coming up. So up next, we'll be taking your emails and your calls. This is how you can reach us. You can call us toll free, 1-855-326-6266, or you can email us at knowyouroptions@bnnbloomberg.ca, and we'll try to answer your questions on the other side of this short break. Stay with us. Welcome back. We are going to start taking your calls and emails here on Know Your Options. So we're going to start with an email from Jim. And this one reads, I sold a put option in TELUS at $18 and the stock was put to me. I sold the May $18 covered call. When a stock is put to you, do you wait and collect the dividend, then sell the covered call? How far out would you sell the covered call? Thank you.
Yeah, so this is a good strategy that you've got here. You sold the put. And then you got put the stock and then turn around and sold a call at the same strike. So you're collecting premium on both sides. And then now that he's long the stock, he will collect that dividend. So I looked at TELUS as you were reading the question. So they don't go ex-dividend until after that option expires. Okay, so a lot of times if you have a higher dividend paying stock and the call options on it will get weighed down in price by that dividend. But because they won't go ex-dividend until June, it's like there's no dividend at all. It's the same as a non-dividend paying stock because there isn't one during that period. So for this, if you're collecting, say, 50 cents over that period, it's out 3 months. That's not a crazy amount of time. You're not going to be bothered by that dividend. The risk of getting called away early is low. So I would say just keep it going, wait till this expires, and then look to do it again. So
you don't want a dividend at this time? Like that's preferable, or does it depend?
Yeah, so let's say this one expires and the stock's in the same spot, and then he sells it out to July. Well, there will be a dividend that's in that. And so instead of getting, say, 50 cents, because there's a 41-cent dividend that gets paid on that stock, it might trade more like 20 cents. So you get paid less on the option, but you're getting the dividend as well. But in this period here that he's asking about, there is no dividend at all.
No dividend at all. Okay. Okay, we're going to go to another email question. This one is coming in from Karen, and it reads, if I sell put contracts or stocks I own, is that considered cash covered in regards to margin available? Thank you for that, Karen. So, yeah, what do you think?
Yeah, so cash covered, obviously, that means that we have the cash to buy the stock. So we sell a put option, that means we're committing. If we sell one contract, that means we're committing to buy 100 shares at that strike. So if it's a $50 strike, it means we've set aside $5,000 for that. So in order to have the ability to sell puts, it does need to be in a margin account. So even if you're not going to be borrowing money from your broker, it does need to be in a margin account, and you're cash covered as long as you set that cash aside.
All right, we've got another email question coming from Brian. This time it reads, I would like to learn how to trade options and was wondering how Chris would use options on Pembina as it is coming up to PPL ex-dividend date. Thank you. Okay, so we'll break this into two questions. So learning how to trade options, first of all. Is there any tips that you can give people who are just getting into this?
Yeah, so pretty much every online brokerage, they're going to have some kind of online education piece to their website. We're not out there pushing any particular do-it-yourself brokerage. But then there's also the Montreal Exchange. Okay, so we actually just did a webinar with them this morning, and that was all about rolling options. So there's a lot of resources, some that we're providing, but that people are out there. I mean, the internet is a big place that has all kinds of information. So I think you can go ahead and do a lot of research before you start actually actively trading.
Okay. His second part of the question is how would Chris use options on Pembina as it's coming up to PPL ex-dividend date?
Yeah, so Pembina, it's not all the pipelines. They tend to be a bit lower volatility names, which means the option prices are not as high. But because it is a higher dividend stock, I was talking about how the price of a call option gets weighed on by dividends. That dividend actually adds to the price of puts. So if it's a stock that you don't own and you do want to own it and you kind of wish you could own it at last month's price, then you can take a look at selling some puts. So the stock is $63 and you can look out to June, the $60 put, and collecting about $1. So you've got that bit of downside protection. If we get that 1 year chart back up, they've given me the pen this time, and so
we're going to use it.
We'll see what we can do here. So the stock is here at $63, and you can sell that $60 put and collect about $1. Okay. So what does that mean? That means that everything in this band here is downside protection. So you don't start to lose money until that stock gets below $60. And then if you are assigned that stock, well, you've collected $1 and you are going to be buying at a net purchase price of 59, right? You got $1, you buy it at 60. So you've got sort of 6 or 7% of downside protection in that position. So if you are wanting to deploy cash and you like Pembina and you don't maybe want to just buy it right here at this level, then you go ahead and sell that put and collect the premium and see what the market gives you.
Do you like Pembina? I'm not sure if that's something you'd comment on, or is there, for someone maybe starting out, is there a better maybe energy company?
Yeah, so we like pipelines in general. So, between Enbridge and TC Energy and Pembina, we kind of rotate between them, depending on what the market is giving us, what the recent share price has done, what the option prices look like. I think in a balanced portfolio, you want to have exposure to the lower volatility part of the energy space on the pipelines, as well as the producers and all that. So.
Especially right now.
Yeah.
Okay, we're going to go to another email. This one coming in from Max, and it says, how best can I manage a bad Brookfield Corporation trade? When BN was trading at $65 in January, I sold a $62 June put and collected $3. BN has now gone down to $53. So should I close it now and sell a lower strike put, or wait till June and hope it goes up? Long term, I still like BN for a hold. Thanks. Okay.
So with this one, the stock was, I think you said, was trading around 65 and sold the 62.
62, yeah.
And so now the stock it's actually around $55. So if a stock is 55 and the strike was 62, that means it's $7 in the money, right? So it's that the intrinsic value of that option is $7. If I look at the market here, that option is trading at about $7.60. So that means that there's 60 cents of time value that is going to erode with the passage of time as we get closer to June. So at this point, to me, there's nothing that you really need to do. If you like the stock, you will participate in the upside up to 62, getting back to that strike. Plus, you've got the added benefit of that 60 cents eroding. Again, this is a bit of a lower volatility name. So 60 cents on a $60 stock is only 1% over like 3 and a bit months. But Then when you get closer to the finish line, when you've got the time value has eroded, and then it's time to roll that and look at something else, then I would maybe buy it back and sell something further in the future. But again, right now you've set up this position. You said I'm willing to buy this stock at 62 minus what I sold the put for, and now you just wait.
You think that's a good idea? Because Max says he likes Brookfield as a long-term hold as well.
Yeah, and so as of right now, you don't get to decide if you get put early, but I'd say the odds are that if the stock stays here, you're buying it or you roll it by buying that option back and selling something further in the future. But if you like it, then and you believe in it, and your thesis hasn't changed as far as the company long term, then you don't always have to trade in order to make an investment decision. You can just leave this and
just sit on it.
Yeah, just wait.
Yeah. Okay. All right. We've got another email. This one coming in from Howard, and it reads, "I am a holder of BN calls prior to the 3-2 stock split last October. I now have a call called BN1, which doesn't have any trading activity since the calls were renamed to BN1. Shouldn't each contract be for 150 share lots after a 3-2 split? I'm very concerned about being able to exit my positions prior to June expiry. What can I do?" So can I just go back to the beginning of this question when he's talking about BN1, like being called a BN1? What does that mean after a stock split?
Yeah. So I pushing options at all times. One thing that can be a real hassle is when stocks split like this. Okay. So if each contract represents 100 shares. But when the stock splits 3 for 2 like this, now each contract is 150 shares. So when a stock is trading, say at 55, your option stays at its previous strike, and it can be a bit of a hassle. Yeah. So the advice on these typically is to try to exit the post-split options, so the BN1s, and then trade into the new options that are trading that are just BN back to 100 shares per contract and all that. So they can be a bit daunting from looking at the liquidity because they don't really trade, because all the institutional money, they step away from the post-split ones that have the different deliverables. So the advice on that would be, try to trade out of it. If you need to send a note to the Montreal Exchange to say, hey, I need to get a fill on this, or I want to roll this into a regular deliverable, what can I do? And then a market maker can try to clean that up with you.
Okay. All right. We've got another email, this one coming from Sam, and it says, with all the volatility in oil prices, which is driving up some oil stocks, do you have an option play idea here?
So the oil ones is interesting. I mean, a lot of them have moved up quite a bit, right? So we were selling puts on, Cenovus and CNQ at much lower prices. So I think at this point, a person needs to sort of reevaluate their view of the oil space. Like, if everything gets cleaned up in the Middle East and, people, wars stop, where will oil fall to? Like, how much production has been shut in? How much isn't going to come back easily? Like, will oil just immediately fall back to $60, or, is $75 or $80 the new floor? So if you think that floor price is now more like 75 or 80, then these companies deserve to trade at higher valuations. So I think if you had sold puts in the past at lower prices and lower strikes, I think you just reevaluate and move those strikes up and just keep going. Because
it's also a time thing as well, right? I expect for options specifically, it really depends on how quickly this gets cleaned up in the Middle East and how long this prolongs for.
Yeah, and the heightened volatility, I mean, we see oil dropping $8, $9 a day because of a tweet, that makes options more expensive. So it's a good place to be if you're comfortable with those prices.
Okay, we're going to take another quick break. Coming up, though, we will get Chris Tom's top option trading idea. So stay with us. That's next. Welcome back. It is time now for Chris Tom's top options trading ideas. So we'll go through these. Your first one is Dollarama, selling May for $165 cash covered put for $3.80.
Yeah, so Dollarama obviously has had a big week here. They had their earnings the other day. I guess same-store sales just didn't excite the market, and it sold off a bit. This a theme here is that these are all repeat trades. Like the thing with selling puts and calls, it's about doing it over and over and over. So I think the last time we sold puts on Dollarama, we sold the December 170 put Stock ran up over 210. Valuation was getting a bit stretched. We took a bit of a break, and then look what happens in the market. It's come back down here. So if we got the chart up on that, the stock is trading in sort of the low 170 range here, and we're going to sell that 165 put and collect $3.80. So we've got that $7 of downside protection between where the stock is now and where we're going to get put that stock. We're also going to get paid $3.80. Okay, so that's 2.25% over 51 days. So if the stock rallies from here, then we make a decent return over a short period of time. If the stock goes down, we're buying it at a discount, and then ideally, the stock kind of hangs around here because we don't really need the stock to go higher to make money with these trades. And then we do it again and again and again. And hopefully I'm sitting at this desk in end of May doing the same trade again.
You're winning either way. Okay, your next one is Wheaton Precious Metals selling May $150 cash cover put for $5.10.
Yeah, so Wheaton, this has been on a real wild ride here. I mean, if we look, the stock is trading in the low 170s here, around 170. And that's where it was 3 months ago, rallied up over $225. Gold's been going wild, silver prices. And so we want to embed a bunch of downside protection here. So the stock's just under 170. We're going to sell the May 150 cash cover put and get $5.10. So we've got that bigger gap here, almost $20 of downside protection before we have to buy that stock. And we're getting paid $5.10. So what's that, like 3.5%? Over a really short period of time. And if we have to own it there, then we're buying it at several months ago prices in a gold market that's going wild. And
is that a bigger gap than usual, like that protection you were talking about? Is that?
So the biggest thing that pushes option pricing is volatility. And this has been a very volatile stock. So the market is implying that this stock could rally, back over 200, or it could fall to 140. But for us, it's a company that we like. They've delivered over the years, year after year after year. They do have some management changes that are coming with Randy Smallwood, longtime CEO, stepping down next week. But if we can buy this stock at that price, then we're comfortable.
Last is General Motors. So this General Motors had an interesting couple of months as well. And you say you're going to sell May $82.50 covered call for $2.50.
Right. So been on here when the stock's in the 50s selling cash covered puts because we're comfortable getting long at that level. Now we've owned it for a long time. We want to generate some additional premium. Stock, I think, is just under $77 at this point. So here we are. I'm loving this pen. And, we're committing to sell the stock at about this level. So we have all of this upside that we participate in, plus we're going to get paid $2.50 for that option, which is a low dividend stock, 63 cents a year. This is 4 years worth of income, and we still have that upside. We'll be selling near in the 52-week high if we have to sell it, and otherwise we'll generate some premium and drive on, look to do it again.
Interesting stuff. Okay, that wraps up this edition of Know Your Options. Definitely bring the pen back next time. I think that really worked for us. Chris Tom will be back in 2 weeks on the show. That's on April 8th to answer more of your questions. Thanks for watching.